This week on 20th March, we have 4 webinars lined up for you. By 10 a.m., we have Comparing IMF with Other Investment Asset Class. 11 a.m., we have 2 webinars. Nifty 50 at the Crossroads. Are you underinsured? Find out in 60 minutes. By 12 a.m., we have the 5 Crore Blueprint, Wealth Strategy for IT Professionals. Link in description. Do join this webinar and make your weekends a happy learning weekends.
Today we are going to start a new format on this channel. Welcome to this show. And in this format, we are going to talk to the doyens of the investment world, those who are going to make a big difference to the way India invests, to the way in which Indians are going to see their wealth creation, and make a lasting impact on how Indians view asset management. Welcome, Ganesh. Thank you for being with me on this show. Today, I'm going to ask you a few questions which relate to how you have made your journey and how you're seeing the road ahead. Firstly, what do you think will create a differentiated asset management company? How can a mutual fund be differentiated? Because you're coming to an industry which is already crowded and you're leading a company which wants to be differentiated in so many ways. But we are all restricted by so many factors. There's categorization, there is how you're going to label, and so many constraints are there. In the middle of all these constraints, how are you going to make a differentiated AMC, or how do you see a differentiated AMC?
First of all, thank you very much, Shyam, for inviting me onto your podcast, and my best wishes to all of your viewers as well. Coming to your question around how do you create a differentiated AMC, this was actually a very important one, because when we joined the industry, we were the 41st AMC. Obviously, 40 AMCs were already present, many of them for more than 30 years. So as a new AMC, you obviously have to create your own differentiation. So we thought long and hard about this particular issue, and we came up with 3 broad areas that we said we will differentiate on. The first was very much that if we are in a field of investments, right, any differentiation has to originate in the field of investment itself. Right? So we looked and did a research on what are the things that maybe are being used globally. Are there certain trends? Are there certain investment techniques, strategies that are being used globally, but maybe not so much in India? And both my CIO and I, we have quite some extensive experience with markets outside India as well. And we found that there was one particular area that a lot of global hedge funds, sovereign wealth funds, asset managers were beginning to use, but was not being used a lot in India, which is really the field of behavioral finance and its application in the field of investing. And this has 2 very simple aspects to it. One is, how do you see the market itself? And the market oscillates like a pendulum between greed and fear, over and underreaction. So how can you identify opportunities within that? And the second is as a lens to yourself, right? We are also human beings. So what are our own biases, our own sort of narratives, trends, etc., that play a role in our decision making? And how do we very critically make sure that we put tools into our investment process to minimize the impact of that? So that was the very first aspect that we worked on. Now that is at a philosophy level where we say, okay, behavioral finance in the field of investing. But philosophy, we will have a very good discussion, but for the common investor,
how does he understand that?
He will not be able to understand the implications of that, which is why the second area became important, which is product differentiation. Because ultimately, investors look at our products. We are manufacturers, we will be known by our products. So we said, let's go to first principles again, right? Any active equity fund that I bring, right, my biggest competitor is actually the benchmark. So I must have strategies that actually work on what are the things that passive or the benchmark cannot do, right? So we did research on that. And what we did was, for every single fund of ours, we chose investment strategies that can compete with passive, right? With the objective that active should do what passive cannot do, right? So that was the second area of differentiation on the product side. The third, I think, is just part of our DNA in a sense, which is Bajaj Finserv generally is known for technology. Right? right? And how we brought technology in the field of financial services, in lending, in insurance, and we felt that there's significant opportunity also in asset management, both for distribution, for investors, for the company itself. How do we leverage technology to make transactions easier, to increase the market potential? Can we actually tap into customers, other assets which are not necessarily in the mutual fund industry, and make their interactions with us far easier? So I would say behavioral finance at a philosophy level, product differentiation relative to passive, and then technology to make life and transactions easier for our customers. I think that's the 3 levels of differentiation. Right?
See, I can appreciate what you're saying, but let's say we have a DIY investor who is looking at our conversation, and he is looking at a category. Let's say large cap.
Yeah.
There's so many large cap products. So how would you make your large cap product different from industry in the way in which you're curating the product, you're managing it, and you're presenting it? How would it be different? Because I'm wanting to know how the differentiation actually translates into a product.
Yeah. Now, this is an excellent question, and you've chosen the, I would say, the trickiest product, right, to talk about, because large cap is actually quite a limited space.
Correct.
Right? There's only 100 stocks.
Correct.
Right? So generally, this becomes the toughest category to generate alpha in to outperform the benchmark.
Correct.
Because these are 100 companies, very well researched. There's no information arbitrage available, and that's why most fund managers actually struggle to beat the benchmark. Right? So the reason for that is structural. Right? When you're creating portfolios, let's say of 50, 60 stocks out of 100, by and large, you're almost recreating the index.
Okay.
So your active share becomes very less. Right? And then becomes very difficult structurally to outperform the benchmark, unless you create a high conviction focused portfolio
within that,
which is what we basically did. We said 25 to 30 stocks. Right? That is what we will focus on. But now, which 25 to 30 stocks? Right? All 100 stocks look very nice. Maybe at least 80, 90 are very, very investable. How do you create these 25 to 30? So we said the champions of corporate India. And we said there are 2 broad themes on which we will be creating these companies. First is India is going through a major shift. Right? It used to be credit scarce. That is not going to be necessarily the case going forward. And because it was credit scarce, actually the ROEs are very high in India. They were around 16% plus. So another highest globally. Right? And you would be very aware of this. That was because only those kind of projects got approved. What is going to happen in the future is more and more capital will get available.
Correct.
But it will be available to a select set of
right
companies
people
and groups much more than to others. Right? Second is capex. Right? So far, the government has been doing the capex, and we all know the story that private sector has not yet come to the party. Right? But government will not continue to do capex forever.
They cannot grow the capex at the rate at which they've grown it in the last 5 years.
Exactly.
That is for sure.
So
they are saying they won't.
Yeah, and there will be an expectation for, I would say, large corporate groups, the corporate champions of India, to take up their fair share. Of course, as and when capacity utilization starts increasing. But now you put both these things together, right? You need to do more capex, and the capital availability at lower cost, that creates competitive advantage. So those companies which are well positioned,
either to give capital or receive capital.
Correct. Exactly.
But participate effectively to get lion's share of the active growth of the economy.
That's right.
The investment growth engines is what you're focusing on.
Correct. And then you create a portfolio which then obviously has greater weightages that is then given to these. That is what creates active.
So basically you're saying that you will buy with higher conviction than what the index is reflecting, which means you're going above the market to buy.
Exactly.
Now I'm going to ask you a question. This category has been generating alpha by buying stocks which are outside the category, which is predominantly small cap companies. So as long as small cap companies were able to, provide that extra turbocharging to the portfolio, things worked. But now it's working the other way. But you kind of, taken a stance very different from the entire category. Can you explain why you took that? First, you explain the stance. I'm not going to tell the stance.
Right.
You explain the stance and then tell me why you took that stance. Because it was so easy to actually mimic and do exactly what others were doing. And it's so difficult to explain why you're not doing what others are doing. So explain that. It's very interesting.
No. So I think it's a very important question. See, SEBI has created certain categories of funds, right? And while they've set minimums, they've not said that you have to be only at that minimum, right? Our view is we want to create true to label products, right? So if it is a large cap, it should be ideally large cap companies. Similarly, in our small cap, you will not see a single large cap name. It's very unique in that sense. So all of our funds, you will see, tend to be very true to label. So what you see should be what you get, right? Now our stance in large cap, of course, is that this is going to be a concentrated portfolio. So if it's concentrated, then it's 25 to 30 stocks. If you start including now some sort of small cap names, etc., then you also give a significant weightage to maybe stocks that are not necessarily so liquid as well, right? So in a concentrated portfolio, you want to also create liquidity. You want to manage risk also very, very, very well. It's possible to do that with large cap names, right? The more you include small caps into those, then you create, firstly, it's not true to label anymore. Second, you create more liquidity risk.
But how did you explain it to investors who said, who are used to seeing, who are set to that idea of having these small cap names in their portfolio?
Yeah, so I would say that everything goes through a cycle, right? There will be times when large caps do well. There will be times when small caps do well. The answer to that actually is proper asset allocation, right? It is not about getting the one fund which has 15% maybe small cap versus another one which has 10% small cap.
No, but you are zero, right?
Yeah.
Industry has got, everyone is using the full 15.
Yeah.
You are at zero. So how do you explain that? Because the investor will keep on asking, why are you not having that? And he might also be misled to believe that rather than buy your product, he can buy the index. So how do you actually counter that?
So the way we do that ideally is by actually showing the active share in the fund. Right? It is actually one of the highest active shares in the large cap category. And active share is really how far are you from the benchmark itself, right? And the closer you are to the benchmark, of course, then you're creating almost a closet index. The further you are, the more you have active share, which gives you a chance of sort of outperforming the index, assuming, of course, your investment processes, tools, etc. are right. So our approach is very much create high active share products.
Can you give one example of one or two companies in your large cap fund which is way above the benchmark weight, just for the viewer to understand?
Yeah. So in our large cap, we have Airtel, for example. We've taken a significant call on that.
Okay.
There are a couple of metal companies as well that we've taken certain calls on those. Obviously, we don't do stock-specific discussions on these.
Right.
But what we have clearly seen is there are certain groups, companies which we see having very good growth potential, who will have access to capital at lower cost, and where we see clearly an opportunity that the capex can be funded at a lower cost for these companies. They are the champions of corporate India.
Basically, you're working the framework to the fullest.
Correct.
And using the framework in your decision making to avoid buying stocks which are not true to label in the product. And so you're basically strengthening the product by constantly strengthening the process to get more out of the framework.
Exactly.
This is in a
exactly
nutshell.
Right.
So now, when you do this, obviously, when you start a portfolio like this, it's not going to immediately deliver return, right?
Yes.
It will take time because you are strengthening the process to meet the requirement of the framework. So no investment product has a process which is ready for the framework, because we all create the framework and then we create the product, and then the process basically rises to meet the demands of the product and the framework. So this period when this happens is a lag in performance. You see a lag in performance. So how do you manage that? How do you manage that period? And what is that ideal gestation?
Yes.
After which the product starts, taking over.
This has actually become a world of very instant returns.
Correct.
Right? I mean, everybody wants very quick, instant gratification, right? So it becomes very, very difficult. You're right, Shyam, in that sense that people, start seeing their funds within, let's say, 1, 2, 3 months, and the expectation of returns are also very, very quick. What we keep telling people is, money that you put in equity, you should ideally bring with a minimum 3 to 5 year horizon, right? So when people start looking very, very soon into their returns, very often you will see an undercooked portfolio, or maybe an undercooked experiences with that portfolio, because things are going to take some time as well. Right? You cannot create a baby within 3 months if you wished, right? It takes certain period of time. Right? We see the same thing with our funds as well, right? The funds which have completed 1 year, 2 years, now we will be getting close to 3 years as well. There have been potentially periods of maybe 3, 6, maybe 9 months of underperformance for a period of time. But those are very, very clear. We understand why those are. We have taken certain calls on certain stocks, etc. And those may not play out in the short term. But our intent is always to give a good experience to investors over a market cycle, which typically is 3 to 5 years. So we tell all our distribution partners, all investors, please come with that 3 to 5 year view and don't take judgment calls too early. If I just give the example of the Flexi Cap, which is our longest duration product, right? Today it is performing quite well. But if you looked at it within the first 6 months, it was actually underperforming the index because we had taken some very specific sector calls, we had taken specific stock calls as well. One of the leading banks in the country was not there in our portfolio, right? And a lot of people, questioned us on that.
Why not?
But there was clearly a merger process going on, and we felt very confident that once that overhang passes, we will increase our weight to that stock.
But that is a very interesting call to take, because the day the merger was announced, the stock bumped up. So initially the market responded thinking that the merger would be value accretive.
Correct.
Turns out that the gestation was underestimated by the market and it became value depletive. So that's a very interesting call that you're saying. Okay.
And once that overhang went out, then of course it became one of our largest weights in the
So you waited to do it.
We waited for that, right? Now that can take a certain time, right? So now imagine first product launched by the AMC, first 6 months you're underperforming. If at that point I give up my investment strategy and I say, no, I'm going to be very much tight, close to the index, plus minus this percent, then you give up on your active share, you give up on your processes or portfolios, and you'll then come back to average as well. Right? So if you have to deliver outperformance, there will be potentially periods when you will look a little bit different, right? You have to have comfort with that. That's the conviction that we try to keep giving to our clients and our distribution partners.
So building and managing this conviction, when you are differentiated, it's going to be taking a lot more energy. How do you manage that as an institution? Because CEO, MD level articulation is one thing, CIO and head of investments level articulation is another thing. But when you go to the street, the guys in the street, they must be facing the heat, right? So they will come back with stress or sometimes fatigue. So how do you manage this? Because this is a very important part of the behavioral finance chain. Because how you manage your internal ecosystem is what is going to determine how you manage your society, right? So can you tell a little bit about how you manage this internal ecosystem? Because it's very important.
It's actually convincing our own teams, our own distribution partners, our own investors, and making sure that conviction stays is a very important part of the AMC itself, right? So what we did is we decided we'll do that through our fact sheets, right? Which is basically the communication I give every month to our investors on what is our portfolio, how is it structured, etc. Our fact sheets are actually quite differentiated, right? And they're designed to create conviction. So what we do is we actually take the entire portfolio that we have, not just the top 10 stocks, the entire portfolio, and we try to show how that portfolio, each single stock in that portfolio is aligned with the investment strategy of that fund, right? Let's say it is mega trends in Flexi Cap, so we'll keep showing whether it's technology, regulatory, economic, so on and so forth. What is the mega trend supporting it? If it's a large and mid cap, which is a quality oriented, then we try to show what are the moats that that business has. In large cap, we show where are the active shares that we've got, which are the highest ones, which are the underweights, etc. Right? So our fund fact sheets actually will look very, very different compared to the other ones in the market. And from our perspective, we actually found that triggers a lot more conversation, a lot more curiosity, a lot of conversations at the stock level also happen, where people say, okay, why is this in the portfolio? Why is this not in the portfolio? And those become very active levers to drive much greater conviction with our investors.
So you're saying the fact sheet not only explains, but it also kindles interest. After it explains.
Correct.
So when you're trying to explain and kindle interest, you're saying that you're addressing the lack of conviction. The conviction gaps get addressed. That's very interesting, because most people in our industry think that fact sheet is, just there for being there. Right? You have to give it, therefore we give it. But what you're seeing is it has a much bigger role and a much wider impact. First internally.
Correct.
And then your own people once they buy in, take the same fact sheet into society and present it the way they have understood it well.
Exactly.
Which means that the selling of a product happens after reasonable understanding of what's going on in the product.
That's right.
That's very interesting. So that is the differentiation. So all this
Absolutely.
conversation of differentiation has brought us to a point where the differentiation begins about how you handle your internal customers
Correct.
and then goes out to the society.
Exactly.
That's very interesting.
And it creates a lot of extra work for us, but I think it's definitely very, very justifiable, for us to do that, particularly if we believe that our funds are quite differentiated.
The industry is seeing rapid growth. Your company is seeing rapid growth. How do you ensure that investors deploy capital in the right assets, the right asset classes? Because you have all the products, but they can choose the wrong product and not the right product.
Yeah.
And in the end, he'll say, oh, this company didn't deliver return to me. But the product choice was his.
Yes.
Right? It's like you have a menu card in which there are a lot of items. He doesn't pick the star items or the ones he should do.
Right.
He goes somewhere and buys something which is not even something to his taste or suited to him. How do you ensure that while you grow fast, you also ensure that investors buy the right assets?
No, it's a very important point because ultimately investor experience will determine future growth.
Correct.
The more investors feel like maybe their investment experience was not good, they also tend to look at other asset classes and maybe they move away from the investment journey that ideally they should be having. So one of the things that we do, at the time of even the launch of every single product, Shyam, we ask ourselves two fundamental questions. In fact, these are the only two questions the board asks me, right? Which is A, is the product differentiated? So is it giving something new and unique to the investor? B, is it in the investor's interest? As in, is it timed well, right? So what we try to do is we make sure that from a timing perspective, from an investment strategy perspective, we are bringing the right sets of things at any point of time for the investor. Right? So roughly about a year and a half ago, we had a choice between, let's say, should we launch a large cap or should we launch a small cap? In fact, we had both approvals, right? And it was very, very clear to us at that point of time that risk reward was far, far greater at that point of time with large cap. About 6 to 9 months later, the picture was a little bit different, right? So we phased our entire launch strategy based on that, right? So we take a very clear view on what is the right strategy and timing for products. The other is where we see products which have very good runway, right? So that if an investor is coming for, let's say, a 3, 5, 10-year kind of a view, these are, let's say, sectoral ones like consumption, healthcare, banking and financial services. We see massive growth runways over there. So those are designed to give good experiences to investors in the long run. So that's how we basically look at it. What we've also tried to do is come at it from a different fund strategy perspective, right? So our flexi cap, for example, is more growth oriented. Then our large and mid cap is more quality oriented. If you look at our multi cap, it's more contra, or it's an intrinsic value contra kind of a fund that is there. Large cap is a concentrated fund. So each has a very different strategy. Right? What we're trying to do is we're trying to give investors a big bouquet of dishes, right, that they can choose from.
No, but how do you make them buy? For example, how do you make them focus on a large cap only at a time when the whole market is running behind a small cap?
Right. Yeah. So this is where we basically keep giving market outlooks very regularly to our investors, to our distribution partners as well, because very often the view is shaped by the intermediary as well in these conversations. Our team actually, we've prepared a model as well where we look at what is the fundamental as well as the sentiment indicator in the market. Right? So we keep sharing views from this, which comes out actually in our balanced advantage fund regularly, where we look at both what is the fair value of Nifty as well as the large cap, how we're looking at different sectors, between large, mid and small cap, and what is the sentiment indicator as well. Remember, I told you that we focus quite a lot on the behavioral finance aspect. So where is the market mood and sentiment at this point of time? And what is that telling us as well? Right? And here actually you get some very good cues from other markets like currency markets, bond markets, commodity markets. All of them give you good cues because equity tends to be one of the last markets to react. These are much more early warning triggers in a sense. So we use all of these to give a consolidated view on the market to our investors. to make sure that they're doing the right set of things. And then we give them different products if they have specific styles that they would like to participate in. Right? One simple thing that we've done is for investors who don't want to take all these calls, right? There is something which we launched which we call Power of Three, right? Which basically has 3 different funds, and each of them has very different unique styles, which you've seen that over a longer period of time, it actually gives a much smoother experience to
It's a basket.
investors. It's a basket.
They just
Exactly.
invest into the
In
basket.
that basket.
Proportion within the basket?
So right now it will be around 40-30-30 between, let's say, you can actually make it whatever you like, but broadly we would say 40% more towards the flexi cap, 30% towards the large and mid, which is the quality, and maybe around 30% in
Maybe
the
this
multi-cap.
will suit a DIY investor, right? Because where he is not able
Exactly.
to make up his mind.
Exactly.
So you are controlling an investor and ensuring he doesn't buy the wrong asset class at the wrong time
Correct.
by giving him a basket
Yes.
into which he can invest.
Correct.
And that basket is an active investing basket. It's not a passive
Yes.
investing basket.
Correct.
Is my understanding correct?
Yeah. So
That's
we
very-
try to time the launch right so that it's a good experience for the investor. We try to give different unique investing strategies so that they can choose which one they want to invest. And if they don't want to take any of those calls, then we have very simple baskets which they can simply allocate.
Now I want to ask you about how this transition of capital, which is a pet subject for you, from the banking system
Yes.
into mutual fund investing.
Yes.
The potential is well known and you have articulated it. You can say it for our viewers of how
Yeah.
much capital is there, how much,
Yeah.
what will be the kind of impact. But you've gone and created a product which you are positioning in front of the investor as an alternative to a bank
Yes.
investment to the bank,
Hmm.
right? Banking product.
Yeah.
And here again, the way in which you have created the product is not based on how you are seeing it in India, but how you are seeing it in another country
Yeah.
where it has worked so well.
Yes.
Tell us a little about this. I found that very,
Yeah.
very interesting. So I want
Yeah.
our viewers to know about it.
No, I think there's one thing which is common to a lot of us in India. We all keep extra money in our savings accounts, right? But what we often don't realize is we are only making about 2.5 to 3% typically annual return on that money, fully taxable in that year. Right? So depending on your tax slab, you're actually getting significantly lower return than that. Very likely, it is not beating inflation. Right? So it's actually an inefficient parking solution for our investors. There is an alternative, right? So if we look at liquid funds or overnight funds, right? Typically, these have given returns which are at least 3.5 to 4% higher,
correct,
than what we've seen in the
savings
accounts, right? There is also good liquidity that is available because SEBI has a fantastic option called the Insta Access facility, which basically allows you to redeem up to 50,000 or 90%, whichever is lower, within a few seconds, right? So up to 50,000 you can actually get very, very quickly, and if you have two, you can basically have between liquid and overnight almost 1 lakh of instant liquidity. Most people don't need more than 50,000 at a moment's notice
for an emergency,
right? Yeah. And if you do, then you probably use a different payment instrument anyway. Right? So this actually takes care of liquidity as well. You get much better returns. So for us, what we're seeing is this is an opportunity for people to actually make much more on their idle money, right? The math is very simple, Shyam. Right? If you keep 1 lakh rupees extra in your savings account, you're losing 10 rupees every day. It's that simple, right? Now, when you bring it into the mutual fund ecosystem, it actually, you have the full, you have daily NAVs, so you can redeem it at any time if you wish. So liquidity is very clearly there. And over a period of time, if you're seeing that you don't really need that money, you can switch it into other alternate products quite easily as well. Right? So we believe that this is something which has a lot of opportunity for anybody in India who has a savings account, which is the vast majority.
But where did you get this idea that you must position this product as something that can draw in so much capital? Everybody thinks that this product is a me too there, which is just going to be present like salt on a thali leaf.
No, this actually has a huge opportunity, Shyam, because if I look at the numbers, right, there's about 88 lakh crores sitting in current accounts and savings accounts, earning between 0 to 3% returns. Now, if I compare that with the amount that is in equity and hybrid, that's probably around 45 lakh crores. So more than 2 times that money is actually sitting in banks, right? So this, I think, is a real opportunity that I think for all our investors, we believe that it's much better deployment of their own surplus money. Making it work harder for them is something that we should bring to
we
them.
owe ourselves that.
Absolutely.
And any global parallels that you want to cite?
Yeah. So China actually did this in the mid 2010s or so. They launched a product called Yuebao. Again, the market structure is very, very similar. About a 3.5% to 4% return gap between what is their sort of savings account equivalent and the an overnight kind of a product. That actually became the world's largest money market fund. Right? So that is the kind of opportunity in a similar market with a similar market structure. Right? So I think that's really what we are seeing as something which, if you convert a nation of savers into a nation of investors, right, you deliver good value to the investors, you can actually create a blockbuster product.
Even in a category like this.
Yes.
By being differentiated, you are of the view that you can actually create a blockbuster product.
That's right.
So in every product that you are trying to bring out, you are trying to bring differentiation with the hope that over time, as the product becomes stronger and stronger,
Yeah.
and society sees it differently, its prospect of becoming a blockbuster product will rise. Not every product can be a blockbuster, but you will find a few which will rise to that level. That's the basic
And our view is very simple, Shyam. If you have a good product which creates a win-win for all the people in that ecosystem and you support it with technology, then you create blockbusters.
Great. Between AMCs who have products in every category and those who have products only in a couple of categories, where do you position yourself? Where is Bajaj Finserv AMC going to be positioned between these two extremes?
So Bajaj is a household name, right? It's a 100-year-old brand. In fact,
Hamara
2026, 2026 is the 100th year of the group, right? So it's a brand which is very well known to all Indians across the country. When we entered the asset management space, it was also clear to us that we want to be a full-fledged asset management house. It's not only about one or two specific categories, but like I said, every fund needs to have a very clear rationale. Right? So we will not just launch funds for the sake of launching. It's not only about asset gathering. Right? It's about bringing very clear strategies that are very differentiated, always in customer interest, and also timed to be in the interest of customers. Right? For us, that's one of the key things that we want to do. We will not have a huge proliferation of products. We believe that as long as we can justify it on the basis of these, we will launch funds. But we will have funds across the spectrum, right? So you will see quite a few equity, hybrid. We already have, I think, close to about 24 schemes that we've already launched between passive, debt, hybrid, as well as equity.
And you're aligning many of these to your megatrend positioning also.
Yeah.
So the product portfolio is aligning to that and not necessarily to what the industry is doing.
That's right.
But how does an investor get to know this? I am getting to know this because I am getting you in a conversation. But in the regular communication, how does an investor who is just sitting in some place remotely, how is he going to get to know this? Because it's very difficult to reach this message, right?
Yes.
How do you do that? Any interesting ways in which you reach this message to that investor?
Yeah. So I think you caught it quite well, Shyam, which is megatrends is something that we have really focused a lot on. And megatrends are like these big ocean currents, right? You have technology, you have regulatory, you have economic changes, you have nature or environmental changes, demographic or social changes. So we call it TRE and DS for short, right? So that's an acronym. But what we do is in our fund fact sheet, like I mentioned earlier, every single stock we actually show across those TRE and DS, which one is it benefiting from? That's step number one. Second is we regularly keep talking about our mega trends to our distribution partners as well, because that's a more easier group to reach out to. We make sure that they're educated and aware about these. We have mega trend seminars. In fact, every Friday afternoon we have a seminar for our partners where we talk about some of these concepts. Sometimes it could be mega trend, something else, right? But slowly we raise the awareness of this, because this is actually India's first and only megatrends related investing opportunity, right? Now, why is megatrends important? Because it's a systematic way of looking at future growth, right? Companies that are benefiting from either TRE and DS are more likely to grow better than ones in the past. And that's a very powerful way to compete with the passive, because passive cannot look into the future.
Correct.
Passive only looks at the past, right? Companies come into the index after they've performed, and the index will have some companies that we know are underperforming. They will continue to be there till they exit. You have to invest in those. Right? So mega trends as an investing concept actually
It's futuristic.
is a future oriented.
Now I'm going to dig you into that last sentence, which I found to be a very powerful statement you made. Passives only dig into the past. They don't go into the future.
Yeah.
Explain this for our viewers, because it's a very, very powerful statement you just made.
Yes. So passive is basically you have an existing index. Passive investing basically takes the companies that are in the index, it looks at the market cap weightages and invests in those. Right? Now, how does a company come into the index? Let's say the large cap index, if we take a look at it. Infosys came into Sensex in March 2000 or so, right? After the entire Y2K run-up. Right? Zomato, now called Eternal, has recently come into the large cap index as well. Right? But we've been seeing it from a long term
Indigo
before.
came in.
Correct. And similarly, all of us will remember, a certain set of stocks, which have been there in the index for a period of time,
and then fallen away.
Now, index does not get to see Infosys before it came into the index.
Correct.
Right. Similarly, index will see the stocks which are there in the index which are underperforming. You have to keep investing in them till they exit. Right. Now, a well-managed, future-looking active equity fund should be able to capture the quote-unquote Infosys of the world and avoid the other ones that are likely to exit.
So that's the thing.
That's the concept.
And more often, if you see in India, for every Infosys, you have 5 companies which the index is seeing late in the day.
Yes.
So
exactly,
you have that damage also which is there.
Exactly.
But somehow this aspect seems to be made light of when we talk about investing in India, because passive is seen as something that can even make up for this late discovery of companies by the index and wrong discovery of companies by the index, because sometimes you can also discover a wrong company late.
Yes.
But then that impact on the index can be quite substantial.
No, you're very right. And I think it's a shortfall of the active equity investing sort of industry. And I'm looking at ourselves in that sense. That we're not able to communicate it well enough. Right. In fact, see, when before our license, right, we had a period of time when we could do a bit of thought process and research. And that's the research that we did, which is what is it that if I have to launch an active equity fund, what are the ways in which I can compete with my biggest competitor, which is a benchmark, right? So what the benchmark cannot do is what my active equity fund should do.
So this quantification, which you would have done in your research, right?
Yeah.
How much is the differential impact, which is the cost of all these actions? Discovering a company rate in an index, rather the index finding such companies late, and the index finding wrong companies. What do you think is this cost in the investing? Is it insignificant or it is significant?
No, is it significant? It is quite significant.
So how significant? Can you put a number to it roughly?
So the number can be very, very large, but at a very conservative level, I would say at least a 2% kind of a return gap on an annual basis.
Which is the TER of the entire product, right? Yes. Why are people having such a campaign against active investing? I'm quite puzzled that this simple aspect is kind of not talked about.
Yes.
Why is this?
Yeah. So I think somewhere the narrative has become shaped around, the TER itself, right? And a lot of people look at it as, this is eating into my returns, right? The point is, what is the alternative, right? The alternative is, let's say, the index, and that is certainly available at a lower cost, right? But let's say if you have something which is available at a 1% TR or 1.1% TR and is giving you sustainably more than 2+% of return gap, which are you better off taking, right? So clearly, I'm not saying that index or passive funds are necessarily bad, right? They are right for a certain set of investors, for those who probably have a very clear that view that this is what it is required for me. But as your investment journey becomes more and more complex, as you start looking beyond just the basic vanilla products, a lot of active funds actually can deliver and have been delivering alpha as well, right? Now, these alphas can be meaningful, right? In many cases, it is actually more than 4 or 5% also on an annual basis, right? 2% I'm giving as a very, very, very conservative figure, right? But when that is the opportunity loss, right? As you get more and more seasoned in your investment journey, we would definitely recommend for people to start looking at active equity investing as well. that can actually create significant opportunity.
It's a very, very interesting case that you have made because it stands out from the general industry narratives and the social media narrative that we have in our country. Which brings me to the next question. How do you see the impact of TER on investment decision making? That's a very, very sensitive point today. Most of the people come to me and say, hey, why this fund? It's got a higher TER than another fund in that same category. Like to me personally, when I'm buying an investment product, I don't look at TER. I look at the portfolio. If I see a winning portfolio, the TER doesn't even matter to me because anyway it's governed by SEBI within certain band. But people are so obsessed about that penny pinching on the TER that they completely refuse to see the merit of the portfolio. They are looking at everything from the prism of TER. So how do you look at this whole thing and how do you talk to society about this? Because it's quite difficult sometimes, right?
Yeah, I think it's important to not be penny wise, pound foolish, right? Think of it as, what is a mutual fund doing? It is creating a portfolio of stocks. Theoretically, you could create that same portfolio by yourself as well.
Correct,
right?
Absolutely.
And it's, you're choosing to outsource it to a fund manager to do this, to do the research. They do their, sort of follow-ups, they check with the companies, they are comfortable managing that investment. That's a day-to-day job. You presumably have some other day-to-day jobs as well, so it's very difficult for people to carve aside that time. What then becomes important, and of course in the fund structure you also have some tax benefits as well. Now what is important is for people to understand that whenever you're taking an outsourcing decision, there is a certain cost to it. SEBI manages and mandates what those costs, etc., should be across different slabs. Right? Now what is important is when you are coming in with an investment decision, right? Are you only focused on the cost of that decision versus the value of that decision?
Correct.
Right? I think these are two very important things which you must separate in our mind. There is the cost of a decision and then there is the resultant value. Right? If the value of the decision significantly outweighs the cost, then frankly cost should not be the primary driver.
That's how I view it.
Yes.
There are many funds where we have killed it. I mean, the returns have been phenomenal.
Yeah.
But I think to myself, if I had looked at the cost, I would have never bought that product.
Yes.
Right?
Yeah.
The fact that I did not worry about the cost and I was purely focused on kind of obsessively focusing on the investment merits made me buy the product. Yeah. Whereas today I am seeing people going over this chart day in and day out, looking at the cost. That's like missing the woods for the trees, right?
So what I would say is probably in like passive funds where the portfolio is going to be exactly the same. Yes, cost becomes a material aspect.
There is no decision at all, no?
Exactly.
It's only in active that the decision comes in.
But when an active fund manager can actually drive alpha, right, and can generate significant outperformance for you, then I think thinking about 50 basis points or 55 basis points is really not very meaningful for an investor. And I think they should move more towards understanding, is the fund likely to do well? Is the fund manager capable of managing my money and generating outperformance versus, am I paying 5 or 10 basis points extra?
There's another aspect. If you pick the right fund and that fund delivers the alpha, that fund attracts capital. It further delivers the alpha because it's alpha delivery is not a few quarter thing. Usually it lasts for a few years. If the manager has grown himself ahead of the fund size, then the fund continues to deliver this for a long periods of time, right? You have seen this with many of our legendary fund managers in our country. There are quite a few of them. I won't name any, but it's there, right? It's there.
Sure.
Now, when this happens, the TR automatically drops because there's a structure to it. So, at the starting point, with a good fund manager in a great product or a product with a lot of promise, TR should not even matter according to me.
Absolutely.
Because if you are right on the decision, the TR will automatically come down. But socially, we seem to be obsessing about this all the time. Especially investors who are investing on their own don't understand this the way in which it should be seen. That's my observation that I want to make.
I think it's a very valid observation, Shyam, and I think it actually is one of the things which tends to go against the investor. Right? See, for a DIY investor or somebody who's just investing on a platform, right? We have 1,500 funds.
Correct.
Right? So for them to make sense of this and try to have some science towards getting to a decision, they try to put some heuristics. Maybe they look at 3-year return, AUM, and expense ratio, and sounds very, very logical. But in each of these, I can almost assure you, I can find ways in which you are probably making mistakes.
Correct.
Right? Each of these metrics.
It can potentially be a deadly cocktail
Yes.
instead of being a
Yes.
winning recipe.
Exactly. So that's what I think we need to make sure that we keep communicating to investors that investing will look very simple, but it is not. It is not easy.
Ganesh, you've said a lot about how you help others invest, how you're creating an ecosystem for others to invest, prosper, and grow. A little bit about your own investing experience, how you invested before you became a part of an asset management company.
Yeah.
What was your journey in investing? How did you invest? How did you grow investments? Because you also have a legacy. Your parents would have invested in a certain way. So when you start earning and investing, they would have come with a certain thought process. Tell me about that phase before you joined this industry, and then a little bit about how you are investing after you have become a part of this industry.
Sure.
It will be interesting to know.
So, Shyam, my beginnings were very, very humble. My father was in the army. My mother was a school teacher. We never really had too much money. We had a very good lifestyle, but never had really too much money. And investment was never even really considered that at that point of time. So most of my investment experience has actually been through trial and error, which I have probably made a lot of mistakes as well in my career. But those have helped me learn. Right? What are the right sets of things to do?
So you invested in equity from a very early stage, or how was it?
Yeah. So very early, I figured out that equity as an asset class is something which can beat inflation.
Okay.
Right? That was
you were convinced early.
Very, very early.
Lovely.
So as soon as I started working, one thing my grandfather told me was save 20% of your salary every month. Make sure you invest that in some equity product. And I think
grandfather told you.
Yes.
That's very interesting. That's very, very interesting.
So he was a chartered accountant, and I guess that was the one piece of advice which he said which stayed with me. And I thank him for that, because I think that has really helped me quite a lot in my journey in my career.
So you invested in shares mostly?
Yeah. So it was predominantly invested in shares. Of course, I made many mistakes also through that journey. But I think over a period of time, after about 2010 or so, I started moving more towards mutual funds. That journey has been very, very good. Post taking on this role, most of my portfolio is obviously now with my own sort of AMC, and except for some maybe historical funds which are just still there, which we don't have equivalent funds for here. But by and large, my money is where my mouth is. So I think our AMC is doing a good job managing that for now.
It's been a pleasure talking to you, Ganesh, and I thank you in the middle of this hectic schedule of visiting Chennai. You've made time for me and for all our viewers. I'm hoping that more investors understand how differentiated you are leading this business, and how you want the differentiated aspect of running a company to benefit investors. Thank you very much for this podcast.
My pleasure, Shyam, and it's always a pleasure discussing with you. The kind of questions and the conversations we have are amazing. And I wish all of your investors as well a very best and happy investing.
Thank you so much.